Hi everybody, Alex Employer from Expert Forex, and in today's video we're going to be looking at 9 ways that you can prevent disasters on your Forex trading account. Now, experienced traders know that risk control is one of the biggest factors in Forex trading. Protecting your trading account is the most important thing, because if that is gone, you have nothing to trade with. The first way of preventing disasters is not to trade at all. Now, that might sound very silly, but there are times not to trade at all. If you're not feeling great, if you are upset, if it's Christmas, if it's New Year, if it's Easter, if it's times when you should be with your family and enjoying yourself, there are times just not to trade. And very often you will make losses if you trade at the wrong times. So we call that sitting on your hands. Looking at the market and sitting on your hands and doing nothing. One of the most difficult things to do. But if you want to prevent losses, that's most probably one of the ones to pay the most attention to. Then obviously the next one is don't trade live money. Now, why am I even putting that slide up? It's because every single day we experience people that want to lose their money. They say, I'm a beginner, but I've got £5,000 in my account. What should I do? Now, if you're a beginner, the last thing you should do is be trading live money. It happens a lot. I mean, just yesterday I got an email. I've got $10,000. I've never traded Forex robots before. Please suggest a Forex robot that I can trade with my $10,000. I mean, really, don't trade live money unless you are 100% confident about what you're doing, either on a manual basis or on a robot trading basis. Robot trading is not just plug in and have a success. You have to be experienced and you need to know how to trade robots. So the next point is just don't trade live money. That will prevent you from losing a lot of money. Then the old favorite, never trade without a stop loss. You never know when the market's going to do something silly, so use a stop loss. A stop loss will basically take you out of the transaction when the transaction is going heavily negative, and it will restrict your losses to a manageable amount. So use stop losses. Now, here is most probably the most important one. If you are trading live money, use small position sizing. Small position sizing will reduce your risk. Should the transaction go bad, your losses will be small. If you are losing, let's say, 1% of your account on any trade, you will have to do almost 100 trades before you've lost your account. So keep your position sizing small so that your losses are small per transaction. Again, the first thing we look at when somebody says, I have a problem on my account, I've lost a lot of money, first thing we do is we look at the position sizing. Then there's another one that people continuously do. They keep on backing a bad technique or a bad robot. So they lose 10% of their account, say, oh, well, maybe it's just the start. And then they lose 20%. And then they lose 30%. And then they lose 40%. And they never stop losing until they've blown their whole account. So the next lesson is, please, if you are trading a losing technique or a losing robot, limit your losses to, say, 10% of your account or 20% of your account. Don't just sit there and see your whole account dwindle down to nothing. Now, all of this must seem to you very elementary, but it happens. And that's why I always say to clients that Forex trading is 70% psychological. Only if you have psychological challenges will you allow your account to systematically drift down and down and down and blow eventually. And the psychological things are things like greed, lack of knowledge, hope, and all those kind of things. Then the next thing is, do not trade hot currencies. Now, when I say a hot currency, the British exit is happening right now. The pound is a hot currency. There's a lot of speculation. Will it happen? Won't it happen? And when the news comes out that it will happen or won't happen, there's going to be a massive jump in the market. And that, in fact, happened in the last 2 days. There were some movements of 900 pips in certain currencies because of news that occurred on the Brexit. So when the Brexit is around, just stay away from the pound crosses. Stay away from the euro crosses, because those are hot currencies. Now, if you are going to trade hot currencies, or you are going to trade breakout currencies, now there's a lot of ways you can tell. The news is one of them, but you can also tell from the multiple moving average techniques, where when they start knotting, they are likely to break out severely. So then you adjust your trading strategies, and you do what we call straddle the market. You do a pending order buy above the market and a pending order sell below the market, and let the market tell you where it's going to go. So rather than guessing which direction the market is going to go, let the market tell you by straddling the market, and it'll take you as shown on the screen. And then there's hedging, and quite honestly, I didn't even want to put this slide on because I don't believe in hedging, but a lot of traders think that if they hedge, instead of using a stop loss, they just enter a trade in the other direction, they are going to be better off. But in the end, that all they've done is they've made the broker rich, because they've entered 2 transactions instead of 1 transaction. And at some stage, they're going to have to break the hedge, and then they're going to be in exactly the same loss position that they were before, and they'll have to make a new trading decision. Now, it's a bit like wetting yourself when you're wearing a pair of black pants. All it does is give you that nice warm feeling, but it doesn't resolve the problem. Now, another way of preventing losses is to have realistic expectations. You need to balance your greed, impatience, urgency, confidence. All those things need to balance with your expectations of how much you can earn. Most people lose money because their expectations are unrealistic. They are so high. They want to double their account every day, or they want to double their account every week. Really, that is going to cause you to take higher risk than you should, and you are going to lose your money in the long run. Now, there's a 10th item that I almost forgot, and I've added it in at the very last year, and that is overtrading, and it is a major one, and I can't believe that I almost left this one off. Overtrading is when you start trading and you start seeing hundreds of deals, and you're just entering them, and when you look, you've got 12 open deals suddenly running. You're risking 1% of your account on every deal, and suddenly you're risking 12% of your account in that particular trading session. Now, if things go wrong, you can lose 12% of your account. If they do go well, you can make a lot of money. But overtrading is one of the major reasons why Forex traders blow their accounts. They expose themselves to too much risk. So although they're using small position sizing on every trade, they are opening so many trades and trading so many currencies simultaneously, they might as well be trading one big deal that's either going to go positive or negative. So overtrading, watch that. It creeps up on you. You don't realize that it's happening. You have to put disciplines in place. I will not expose more than 3% of my account at any one time. And when you reach that limit, you stop trading. You either close a positive deal and replace it with another one, but you do not go past that limit. And overtrading is what that is all about. Now, there's another form of overtrading that is also easy to happen, and without you realizing that it's happening. So for instance, let's say you open a buy in the pound USD. Then you open a buy in the pound yen. Then you open a buy in the pound New Zealand. So what you've actually done is you are heavily investing up to, let's say, 3% or even much higher into one currency's direction. You want the pound to buy in all three of those deals. And that's also very easy to do. So you can end up with 10 transactions all buying the pound in different crosses. But in fact, it's only one transaction because you're buying the pound in all of them. And that's also a form of overtrading. Be careful of that. That can also creep in extremely easy. Some of our EAs have got tests to prevent overtrading one particular currency. Now, I hope you've enjoyed this video, and I hope I've given you ideas of the type of things you should be looking out at when trading the Forex market. In fact, this is a checklist. If things have gone really badly wrong on your trading account, take this checklist out and check your trading account against this checklist, and you'll find you will have been slack in discipline on any one of these 10 items now, because I've added the overtrading at the end. Now, if you have any comments on any of the points that I've raised, or you have points that I might not have raised, just make them in the YouTube comments facility, and we can have a chat about that. So from me, Alex Deployer, cheerio.